Ever wondered how some people get richer during a financial crisis while most lose their shirts? It's not luck. It's a pattern, a four-stage playbook that repeats throughout history. And right now, the signs are flashing that we're on the brink of another major market event, likely between 2025 and 2026. If you understand this cycle, you can not only protect yourself, but also position yourself for incredible opportunities. Let's rewind. Financial history isn't just a random series of booms and busts. It follows a predictable script. Smart money, the real insiders, don't get caught by surprise. They orchestrate their moves years in advance. Let's break down their four-stage strategy and see how it applies to today. Stage 1 is called the quiet exit. This happens about 12 to 18 months before the house of cards tumbles. It's when the market feels euphoric, when everyone believes the party will never end. But the smart money sees the writing on the wall. Valuations get stretched to absurd levels, completely detached from reality. This is their signal to cash out. Think of Joseph Kennedy, who famously sold his stocks right before the 1929 crash after getting stock tips from a shoeshine boy. He figured if everyone was a stock market genius, the top was in. Fast forward to the 2008 crisis. Who was one of the first to see the subprime mortgage bubble? Michael Burry. He started betting against it as early as 2005, liquidating his other positions to focus on the big short. So, who's quietly exiting today? Look at the headlines. Warren Buffett is sitting on a record-breaking pile of cash over $189 billion. He's selling stocks, not buying. And he's not alone. Jeff Bezos, Mark Zuckerberg, Jamie Dimon, and a massive wave of corporate executives and insiders have been selling their own company stock at a frantic pace. This is the largest wave of insider selling we've seen in years. These are the people who know their companies better than anyone. When they're all rushing for the exits at the same time, you have to ask yourself, what do they know that we don't? They're getting out while the getting is good, turning their overvalued paper assets into cold, hard cash. That's stage 1. Now for stage 2. Buying insurance. This phase typically kicks in about 6 to 12 months before the crash. After cashing out, smart investors don't just sit on their hands, they start buying protection. Think of it like buying fire insurance on a house you suspect might be flammable. These are financial instruments that skyrocket in value when the market plummets. Back in 1929, this meant short selling, betting that stock prices would fall. Jesse Livermore, the legendary trader, made a fortune doing this. In the lead-up to 2008, the weapon of choice was the credit default swap, or CDS. Michael Burry and others used these to bet against the housing market. A CDS is basically an insurance policy on a loan. If the borrower defaults, the insurance pays out. They were buying insurance on bundles of mortgages they knew were destined to fail. What's the equivalent today? We're seeing a huge surge in demand for similar crash protection. The put-to-call ratio, which measures bearish bets versus bullish bets, has been elevated. A lot of investors are buying put options, which give them the right to sell stocks at a certain price, protecting them from a downturn. We're also seeing a big increase in people buying VIX call options. The VIX is known as the fear index. Buying calls on it is a direct bet that market volatility and panic are about to spike. And remember those credit default swaps from 2008? They're back. This time, the focus is on commercial mortgage-backed securities. Investors are buying insurance against defaults in the commercial real estate sector, which, as we'll see, is in deep, deep trouble. This is the smart money setting up their safety net, preparing to profit from the chaos they see coming. This brings us to stage 3, the targeted attack. This is the most aggressive phase, usually happening 3 to 6 months before the main event. Here, investors move from general protection to making highly concentrated bets against the weakest links in the system. They've identified the specific sectors or companies that are most likely to implode, and they go for the jugular. In 2008, this was the moment of truth for the subprime mortgage market. Investors like John Paulson didn't just buy generic market insurance. They shorted specific subprime mortgage bonds and the financial institutions, like Lehman Brothers and Bear Stearns, that were drowning in them. It was a sniper-like approach, targeting the epicenters of the crisis. So, where are the snipers aiming today? The two big targets are glaringly obvious: commercial real estate and regional banks. The commercial real estate market is facing a perfect storm. The shift to remote work has left office buildings empty, and soaring interest rates have made it impossible for property owners to refinance their massive debts. We're already seeing defaults starting to ripple through the system. This isn't a secret. The smart money is heavily shorting real estate investment trusts and companies exposed to commercial loans. The second target is regional banks. Remember the collapse of Silicon Valley Bank and First Republic Bank last year? That wasn't a one-off event, it was a warning shot. These smaller banks are heavily exposed to the commercial real estate mess. They hold the loans on those empty office buildings. As those loans go bad, the bank's balance sheets will crumble. Investors are actively shorting these regional bank stocks, anticipating another wave of failures. We are squarely in stage 3 right now. The fuses have been lit, and we're just waiting for the explosion. All of this leads to the grand finale. Stage 4, buying at the bottom. This is where generational wealth is made. After the crash happens, when fear is at its absolute peak, when headlines are screaming about the end of the world and everyone is panic selling, that's when the smart money, with its mountains of cash, steps back in. This is the moment of maximum pessimism. As Baron Rothschild famously said, the time to buy is when there's blood in the streets. In 1932, after the dust from the 1929 crash had settled, Joseph Kennedy used the cash he'd preserved to buy assets for pennies on the dollar, massively increasing his family's fortune. In the depths of the 2008-2009 crisis, who was the buyer of last resort? Warren Buffett. He injected billions into giants like Goldman Sachs and Bank of America, getting sweetheart deals that paid off handsomely for years to come. He was deploying his cash when everyone else was paralyzed by fear. And that is exactly what is being set up for 2025 or 2026. Buffett's record cash pile isn't just for defense, it's his shopping list fund for the coming fire sale. Private equity firms are also sitting on trillions of dollars in dry powder, waiting for the same opportunity. They plan to swoop in and buy distressed companies, real estate, and other assets at rock-bottom prices once the panic sets in. This is the final and most profitable step of the cycle, turning the market's fear into their fortune. So, what does this all mean for you, the average investor? It means you don't have to be a victim of the cycle. You can prepare for it. The data strongly suggests we're at the tail end of stage 3, with a major market downturn likely within the next 6 to 18 months. The Buffett indicator, which compares the stock market's valuation to the GDP, is at historic highs, even higher than the dot-com bubble. Insider selling is off the charts. Commercial real estate is teetering. The warning signs are everywhere. This isn't a time to panic, it's a time to prepare. The first and most important step is to build up your cash reserves. Cash is not trash in a crisis, it's power. It gives you the stability to weather the storm and the ammunition to seize opportunities in stage 4. Second, if you're comfortable with it, you can look into protective measures like buying put options on major indexes to hedge your portfolio against a decline. This is what the pros do, and it's more accessible than you might think. Third, and most crucially, start making your shopping list now. While the market is still calm, research and identify high-quality, fundamentally strong companies that you'd love to own for the long term. These are the companies with strong balance sheets, durable competitive advantages, and great leadership. When the crisis hits and their stock prices get hammered along with everything else, you won't be panicking. You'll be ready to buy your favorite companies at a 30, 40, or even 50% discount. The coming crisis isn't something to fear if you're prepared. It's an opportunity. By understanding this 4-stage playbook, you can change your financial future. Don't follow the herd into the slaughterhouse. Follow the smart money, stay patient, and get ready to buy when there's blood in the streets. Thanks for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more insights on how to navigate the markets. Let me know in the comments which companies are on your watch list for the next big sale. Stay safe and invest smart.